Okay, welcome back. So I hope that first video was super valuable for you, just to give you kind of some philosophical ideas of the difference between the base and the PUA. Now what I want to do is I want to break down for you kind of mechanically of what's going on behind the scenes there. Right now, these numbers are for illustrative purposes only. This isn't exact or finite. So please don't get lost in these numbers. Don't shoot me an email or send me a message saying this is wrong. I understand that it's wrong, right? Every carrier is going to be a little different, but I think conceptually, this is going to give you a good idea of how this works. So when we look at the base premium, let's use this round number that we looked at before. Let's say you were going to put $10,000 a year towards the base, right? And let's say that that buys a $500,000 death benefit. Again, I'm just kind of making these numbers up as I go. What that means then, from a dollars and cents standpoint for the cash value, is that year one, when you make that $10,000 contribution, roughly 0% is going to show up in cash. Why is that? Well, big reason is because this is buying a really large death benefit, and they have to set money aside to be able to pay claims, to honor guarantees, for overhead, for compensation, all those types of things. So year two, when we make that year two contribution, roughly 25% of the year two contribution is what's going to show up in cash, right? It's a little bit better, but it's not that great, right? This is why, I say this is kind of for the long term, right? It's that set it and forget it type money. You get to year three, roughly 50% is now going to show up in cash, right? And right around year four, right, year five, now what you're seeing is this compounded growth, right, going forward on that base premium. Well, from a PUA standpoint, this is really interesting, is that if we were to isolate this, now I can't have a policy that's all PUA, right? Unfortunately, that we can't do that. We have to have some level of base to put the PUA kind of into, if you will. But if we did $10,000 a year towards the PUA, say that may only buy $50,000 of death benefit. Well, that's a much smaller amount of insurance, or AKA risk, to the insurance company, right? So what does that mean in terms of dollars and cents for you and your policy? Well, let's take a look at that. So in year one, when you make that $10,000 PUA contribution, roughly 93% of that's going to show up in cash, earning dividends and interest. Like I said, it's kind of like rocket fuel, right? Then year two, you make that $10,000 contribution, and roughly 93% of that's going to show up in cash. And every single year that we make the dividend and interest, the PUA contribution, roughly 93% of that is going to show up in cash. So now what I want you to notice is, as I've kind of laid this out for you, what do you notice about the difference in these contributions over time? Yeah, is that eventually the base premium becomes more efficient, long-term, more efficient than the PUA. This is why we use the PUA in the short term to help kind of collapse time, if you will, so that you have more cash early on, and these policies operate and function so much more efficiently for us to be able to go and do the things that we want to do with these policies. So I hope this was really helpful for you. If you guys want to dig in a little bit more and get further into the weeds on this, please reach out to us. Let us know. We'd be more than happy to help you out with whatever you guys need. Talk soon.